Hey guys, how's it going? It's Andy from Magoo Investing. Happy Friday. At this point, as surprising as it sounds, pretty much everything is back to normal in the stock market. Looking at the overall market, stuff like the NASDAQ is up 2.5% year to date. So all of that craziness that we saw in March has been taken away by stuff that we've seen so far in May and all through April. But someone in the comments on my last video brought up a great point, and they wanted me to talk about some stocks that have been hit pretty hard and are still at significant discounts. So in today's video, I'm going to be talking about 4 different stocks that I have identified as having decent potential in the future and are still at a significant discount. The person in the comment section asked for 50%, but there's not a lot of stocks down 50%. But most of these stocks in this video are down between 30 and 60%, and compared to how they normally move, that is a significant discount. Obviously, I do need to say that all of these stocks have significant risk associated with them. That's based off the fact that they have not recovered from the crash that we saw in March. When we look at companies like Microsoft and Nike, there are blue chip stocks that have done pretty well. Microsoft is up so far this year, and Nike is doing better than most of the retailers in that sector. But if you are looking for established companies at a significant discount, these are 4 companies I would consider looking at. Before we get started, I do need to say that I'm not a licensed financial advisor, and this is not financial advice. You should do your research on your own companies before taking any positions. And if you do like these videos, I really appreciate it if you hit that like and subscribe button. It would help my channel out a lot. The first stock I wanted to take a look at is Walgreens Boots Alliance, ticker symbol WBA. Currently, the stock trades for around $40, and it's down 31% year to date. This is a company that I talked about at the end of 2019, where I identified it as being the worst performer in the Dow Jones. And at this point, it is not the worst performing stock, but it is still down significantly. At this point, it is just barely above the 52-week lows of 39.41 that we saw just a couple weeks ago. Looking at the all-time chart, you can kind of see why this might be an attractive play. This is a price that we have not seen for Walgreens since 2013, so you're getting pretty much 7 years worth of a discount. Now let's start talking about the overall business to get a better understanding of what we're investing in. When you break down the 3 main sources of revenue, it comes from the pharmacy, retail, and then wholesale. But when you look specifically, it's the pharmacy that makes the most amount of money, being around 60% of their overall revenue. Also, the stuff that they're selling there has the highest level of margin, meaning that they're going to be bringing in the most amount of money from that, and is the most important aspect of their business. But those margins are some of the main reason that I've identified that the stock is at such a discount. And one of the main players in that is Amazon. Amazon has put themselves into the pharmacy industry by creating PillPack, which is one of their businesses that'll deal with online transactions for pharmacies. Anytime Amazon goes into your sector, you need to be pretty worried. Some of the main problems with that is the fact that they can survive on razor slim margins, which is something that Walgreens cannot do. PillPack has not really established themselves as being a major force in the pharmacy industry, but anytime Amazon starts getting involved, you kind of have to keep an eye on them. Some recent news is that Walgreens partnered up with Postmates, which I thought was just an interesting combination, and it makes it so that some of their retail products and some of their over-the-counter products can be delivered to people at home during the virus. I thought this was a really smart idea, pairing these 2 companies that are very reliant on consumers going out and buying things, so it makes a lot of sense to me. Probably the most attractive thing about Walgreens is their dividend of around 4.3% and a payout ratio of 33%. And so I've learned my lesson from the last video. I got my information from NASDAQ.com, and it gave me very incorrect data. I talked about AT&T having a pretty decent payout ratio, when in reality it was much higher than I thought. So that was something that Scott pointed out to me in my last video. So if you ever see anything where I use some information that's completely wrong, I really appreciate if you would call me out for it in the comment section down below. So just a reminder that the payout ratio is the percentage of earnings that is paid in a dividend. So 33% means 33% of their earnings is being paid to the investors. And so that is a very solid number. I usually look at around 55 to 60% as being the cutoff where it's no longer healthy to pay that much of a dividend based off of how much money they're making. But 33% looks pretty solid. They also currently have 44 straight years of dividend growth, which is an incredibly long time for dividend growth. I usually look for growth of more than 5 years, but 44 years is just that's just impressive on its own. While not having extreme revenue growth in the past, they have had a 16% increase in revenue over the past 2 years. That's not as good as what we've seen in the past, but it's still pretty solid. Also, this is a company that has international exposure, which I think is fantastic as it looks like other places in the world are starting to open up faster. And the Boots part of Walgreens Boots Alliance is the chain of stores that are in the UK. And so that international exposure is something that you should consider while taking a position. Looking at the PE ratio, which is a common way that investors kind of gauge how undervalued or overvalued a company is, Walgreens is very low at around 7 right now, and it's historically low. So that could mean that it's going towards bankruptcy, or it could mean that the market is kind of overreacting to what they've been seeing based off of the fundamentals of the companies. So 7 is a very low ratio for this company. But probably the most attractive thing besides the dividend is the fact that they're on a 31% discount year to date, and these are prices that they have not been seen since 2013. So that's kind of the main attractive part about this company. So now let's start talking about some of the dangers. And as I've already mentioned, anytime you have a retail store that has Amazon start knocking on the doors of your sector, you need to take note of that. While Amazon hasn't fully burst onto the scene yet, I think it's something that we're going to be seeing take more of a market share in the next couple years. As I put the margin on the screen right now, I'm expecting to see this either stay the same at the lows that we're seeing right now or continue to decrease over time as Amazon continues to undercut these main retailers. When I look at long-term debt, which is kind of a way that I determine the overall stability of a company, I first looked at CVS, which in my mind is the main competition in this sector, and they have $85 billion of debt. And so that was kind of the main reason I didn't want to talk about them. But when we look at Walgreens, they went from having relatively low overall debt to it spiking in the last quarter. Just a couple months ago, they had $11 billion in debt, and then just this last quarter, now they have 32.5. And that increase in debt seems to be a way to either protect the company or try to expand further to try to increase their revenue overall. So either way, it's something that could pay off very well for the company, or it could be something that is going to take them down in the long run. And so a debt to equity ratio of over 1 is something that you really need to take a look at. Overall, Walgreens Boots Alliance has some attractive parts to it. Its low PE ratio, high dividend yield, the 44 years of dividend growth, and a discount that we have not seen since 2013. So it has those attractive parts. However, any physical retailer right now has a lot of problems associated with it. And now that Amazon's starting to get involved, that is a kind of a red flag going up. And I would assume that the margins that the company has seen in the past are no longer going to be realistic in the future. So that's something to take into account in addition to the massive increase in long-term debt that they've recently seen. Overall, I think Walgreens Boots Alliance is a decent opportunity. You get the 30% discount, but it also has a lot of long-term problems in my opinion. As with pretty much any company on this list, there are positives and negatives associated with this company. And let me know what you think about those positives and negatives in the comment section down below. Next up is one of my personal favorite companies and something I haven't talked about on this channel in a couple months, and that is Boeing, ticker symbol BA. We went from talking about Walgreens, which was the worst performing stock in the Dow Jones of 2019, and now we've transitioned to the worst performing stock in the Dow Jones so far this year. Currently, Boeing is down around 60% year to date. Currently, the stock is trading around $130, and when you look at the 52-week range for this company, it is crazy. You have lows of $90 and highs of around $400. So that range is incredible for such a well-established company like Boeing. But as pretty much I feel like everyone understands at this point, there are two main factors that have pushed Boeing down so far. First was the problems associated with the 2 crashes of their 737 MAX planes that resulted in eventually the grounding of that entire brand new fleet. And that was what pushed them down at the end of 2019, as mainly the reason why I was pretty bullish on them going into 2020. And then the virus hit and hurt the overall travel industry, and now there's absolutely no demand for new planes. So at this point, they've got a lot of problems with that. Unlike most of the airline industry, Boeing did not end up taking the $25 billion bailout from the US government. Part of the main reason that they did not take this money is they did not want the US taxpayers to have a stake in the company. This is really interesting when you look at the fact that over the past 5 years, the company has paid out $60 billion in dividends and stock buybacks. You've seen this a lot, especially in the travel industry, where the company has continued to go aggressive with the stock buybacks to push up the stock price for Wall Street, but then it comes at the damage of the overall company. And now that $25 billion that they needed, well, they've spent $60 billion in the past 5 years on stuff to inflate the share price. Well, I don't really want to talk about this further. This is a massive problem that we're seeing in Wall Street, and it's something that needs to be discussed in the future. Shares of Boeing increased on Thursday as there was news reports and a lot of optimism going on in the overall market. And so until the overall economy and kind of the world opens up, there's probably going to be very little demand for Boeing. But when that does happen, I do see a potential that there's going to be an incredible bounce of this stock. The main reason is I think that there's potential that the groundings of those planes might come to an end at around the same time that the overall world economy starts opening up again. So if those two things happen pretty close to each other, I expect a huge jump in the share price. Also, with some of the things that we've seen with these airline stocks and just the travel industry overall, it seems like the US government will bail out these companies at pretty much all costs. And while we've seen that Boeing doesn't want to take money from the federal government, you don't have the risks of them going completely bankrupt. Boeing is not the type of company that the US can afford to have go under. They are a major player in the defense industry, and they have plenty of US government contracts. So while Boeing is at an incredible discount, they still have a lot of problems that they need to fix, which is why I think it has a lot of potential for a long-term play, but also has a lot of risk in the near future. Let me know what you think about Boeing stock in the comment section down below. Next up, I want to go from talking about the manufacturers to actually one of the airlines, and now we're going to be talking about Delta, ticker symbol DAL. Delta has been in the news a lot recently. It began with the bailout that gave all of the airlines a lot of hope, which pushed the stock price up, and then they have continued to fall. And in the past week, we had the major news event about Warren Buffett coming out and saying that he sold all of his airline stocks. And as a result, the company is down 63% year to date, and the company is currently trading around $21. So I made a video a couple weeks ago talking about the overall airline industry and identified some of the companies that I thought were probably the best bet if you had to invest in the airline industry, and identified Delta and Southwest. I mainly wanted to talk about Delta because I think it has a lot of potential going forward. Probably the biggest thing that stood out to me is when I looked at their revenue chart over time, I was really keen in on 2007 to 2009 during the last recession, and I wanted to see how revenue changed during that time. And we saw a pretty steady increase over there, and if you didn't know what happened with the last recession during that time, you wouldn't have been able to pick it out. And then when you go to an airline like American, you can see the steady drop during that time. So that overall stability makes me feel pretty good, as we're likely going to be going into another recession pretty soon. Also, looking at the overall airline industry, they had the highest margin of around 10%, and while that has dropped down to 7% as a result of the last earnings report, that is really good to hear, because as things start opening up again, having a higher margin means that the company is more efficient at taking revenue and keeping it as overall net income. As a result of the debt that they've had to pile on in the past couple months, their debt to equity ratio is around 1.25, which is higher than the previous that we saw at 0.92. When you look at some of the other players in this industry, especially American, which God forbid, stay away from that at all costs, they have a massive amount of debt to equity, and you can't even look at it because shareholder equity is negative. And so while Warren Buffett thinks that travel habits are not going to be going back to normal after this finishes, I don't think that way. I think airlines have a lot of potential in the future, especially based off the fact that the US government has shown that they will bail them out at all costs. So there's not as much risk as what we've seen in the past when we had around 12 airlines kind of merge into the major four that we see today. So overall, I think that Delta is the most set up to take advantage of this recovery. While their company has been hurt really bad right now, if you are not involved in the airline industry and had to pick one stock to invest in, I think Delta, ticker symbol DAL, is the one I would look at. You've seen from the company that they can do pretty well during the past recession. When you see their steady increase of revenue during that time, they have probably the best margin in the overall industry, meaning that when things do open up again, they're going to be able to take in more money compared to the overall industry. And their debt to equity ratio is relatively stable compared to some of the other players in this sector. So while Delta has still a lot of problems before the overall US economy opens up, I think it's the best option in the airline industry. Let me know what you think about Delta stock in the comment section down below. And finally, I want to talk about Bank of America, ticker symbol BAC. This is the bank that I personally use, and while I don't love their overall product, I think it's probably the best opportunity in the financial sector. Currently, the stock is trading around $23 and it's down 35% year to date. And when you look at that overall sector, the financial sector has been hit pretty hard compared to the overall market. When you look at that sector, it's down 22.5% in the past 3 months, which is much lower than the overall market. Part of the main factor that has pushed stocks so low is the fact that the Federal Reserve came out and cut interest rates to pretty much zero. And they've come out and say that it's going to stay like that for a decent amount of time in the future. It has hurt the overall income of these major banks, and we've seen that with the earnings report that we'll talk about in a couple minutes. When I show the 5-year chart, you can see the relative stability that this company has had in the past 5 years. And then when I show the all-time chart, you can see the overall damage that the recession had on bank stocks overall, and specifically Bank of America. Currently, Bank of America has a dividend of around 3.2% and has a 43% payout ratio, which is higher than something like Walgreens, but it's not at the 55 to 60% ratio that I start getting worried about. Also, they have been increasing that dividend for 6 straight years. That's also a positive thing. Not the 44 years that we saw with Walgreens, but 6 years is pretty solid. So during their last earnings report, Bank of America dropped 6% because of the news that their earnings per share dropped 42%, which is a massive drop. But when I look at the overall revenue, it is pretty similar to where we saw it a year ago. So while the damage has been seen, it's not as bad as I would have thought. There has been news about the overall sector taking $22 billion in lost provisions to make sure that they can afford if people don't end up paying their loans. Overall, there still are a lot of problems associated with Bank of America, especially seeing that the Federal Reserve has come out and said that they will keep interest rates at zero for pretty much as long as it needs to be there. And so that is a big detriment to the overall financial sector. But I think some of the things I see with Bank of America, that drop in revenue was not as bad as originally thought, a pretty solid dividend ratio, and a lower payout ratio than some of the areas that I get worried about it. And I think that it's a decent opportunity. Obviously 30% is nowhere near what we saw with Delta or Boeing, but it's still pretty solid when you take a look at the overall market being pretty much positive year to date. Like all of these stocks that I talked about in this video, they have a lot of problems. When you look at Walgreens, their main competition with Amazon coming in is a huge thing to watch. And then the other three companies are kind of dealing with their own thing, mainly the virus, Boeing with the restrictions on their 737 MAX planes, and so all of these companies have problems and there are risks associated with them. But the incredible discount that you can get on these companies, if you feel confident in the stock, could be a great buying opportunity. As we're starting to see things open up a little more, this might be the end of the lockdowns. I don't think that's correct, but we're starting to see the trend across the world that things are starting to open up. And these are the companies that have been hit hardest during this time. So let me know what you thought about each of these companies, and let me know if you thought there's a discounted company that I missed and did not talk about. Thanks for watching this video. Stay inside, and I'll see you in the next episode.